opposite here. Today I want to talk about the roles that fund managers play in vastly different parts of the capital stack, and then talk about what the value add is they offer as fund managers. Now, for the viewers that are watching this, a lot of people invest their own money, and that's great. I'm a complete advocate. But there might be a time where you spend a little bit of money. I'm not spruiking for these guys, but you might find a fund manager. So what I want to do today is talk a little bit about the tools that are available to them and some of the information that's available to them that maybe not necessarily easy available to the people who are watching the show. And there'll be certain things that you'll do.
Sure.
So how's business? Tell us about that, Roger.
Well, you know, it's the 6 months to December or January were really challenging, partly because of what everyone now describes as a rotation out of mid-cap quality into what I would describe as junk, but resource companies and the financials.
Yep.
The financials aren't junk, obviously, but I wouldn't want to own a cyclical resource company, and I'll talk about why a little bit later on.
Sure.
And so that made our short-term performance look average because we really didn't go anywhere, and the market surged.
Yep.
Now, we expect that if 2 years out of 10 or 3 years out of 10, you know, we may underperform an index, but that index is led by companies that we think are mediocre, and so we don't mind. We're indifferent as to the index. You know, we're index unaware, and so you'd expect occasionally for us to go sideways when those stocks don't run.
Yep, perfect. What about yourself? In terms of when you hear the idea that the equity market's a buy or a sell, does that, there's a sense of frustration when you hear that commentary that it's just so
it's irrelevant.
Broad.
It's irrelevant. I mean, it's relevant if you're in
behaviour, like it's everywhere.
It's relevant if you're an index investor.
Yeah.
You care about what the index has done. But if you're not an index investor, and we're not, we think that the index is dominated by mediocre very large companies, then it's completely irrelevant to us. So if the Dow goes up 20 points or down 20 points or 200 points, it's really neither here nor there. What we're interested in is the difference between the valuation of a great company and its share price.
But isn't the key to that, look, I suppose the point I'm trying to make is the people that are giving you money, that are investing in the fund, who are hearing that commentary, and the same for Chris, the bond market's bad or the equity market's good or the equity...
It doesn't drive our return. So we had, for example, in 2000...
the behaviour in terms of giving you money?
Well, fortunately not for us, because we think we do a really good job of educating investors, and being on this show is part of that. And so we only want to attract investors that understand what it is that we do. But for example, in 2011 and 2012, in both years, the market posted negative returns, and yet we generated positive returns. In fact, we were one of, you could count on one hand the number of funds in Australia that generated positive return, and the Montgomery Private Fund was one of those. So it's irrelevant, really. And then there was years where I came on your program several years ago and I said, look, we're going to have a really average performance this year from the market. And that was right. The market ended up going sideways, but we generated 16 or 17%. So, you know, it's really irrelevant to us.
We're going to just turn that to good value for those who invested.
But take a step back, Mark, and think about where we are in history. You know, we've seen 35-year declining US 10-year treasuries for the last 35 years. They're now up to 2.6%, up from 1.36% in July last year. And at the same time, CCC rated junk bonds, the yield over 10-year treasuries has compressed from about 8.5% or 9% at the start of 2016 to just under 4% today. And that's what spurred that. That feels like a blow-off top for me. You know, when you get talking about junk bonds, you get Italy issuing a 50-year bond. We talked about this during the break at just under 2% for 50 years. But Austria doing it for just over 2% for 70 years.
That is the world of the institutional fund managers and what they do with derivatives around that.
But what it does is it squeezes every asset because people move on to the next. And that's why I mean, this sounds unrelated, but we're seeing record prices for low-digit number plates. We're seeing record prices for wine, record prices for art, record prices for real estate. It's all a function of the fact that people can't find a decent return, and yet they're still willing to pay top prices. Well, property prices are absurd.
So full of cash. So what do you do? What are the people here who
well,
are
do you know what? This
getting
is the thing.
All the dividends are coming out now for the...
I like what Chris is doing. Chris is in cash. He's keeping the duration short. He's looking for floating rate notes, floating rate bonds, because if interest rates go up, the investor still gets the benefit of that change in interest rates. But if you're in a long duration fixed asset, be it a block of land or a property or a business or, you know, whatever it is, long duration assets are susceptible to the risk of a change in interest rates, the risk of emerging inflation or inflation expectations, or a credit event. And do you think any of those three things are going to happen over 70 years? Of course they will. So people who've bought those Austrian bonds are going to lose money.
Yeah, that's right, but they don't hold them for 70 years. And that's instos, and they're going to trade credit default swaps and trying to find some other ways of, you know, leveraging being invested.
But this is a show not for instos.
Exactly.
This is a show for retail investors.
Up Austrian...
No, but what it does...
Buying that.
But it goes back to the point that I made earlier, that it's squeezing everything.
Absolutely.
Everything's priced off everything else.
My next question
and so people are unwittingly pawns in a very big game of chess that they're going to lose.
Completely agree, because they're aware of it. So where do you see good value? That's the key to this, because that's what for the people that are watching this show, do they buy NAB capital notes at 220 and think, OK, NAB can pay back their debts? Do they buy the hybrids that Chris liked for CBA? You like the CBA hybrid? You know, you could buy that. There's a lot around for those, but where do you see good value at the moment? What do people do with their money? Because at the moment they're swamped with cash.
But people don't realise sometimes the best thing is to do nothing. You don't have to be doing something every single day. It's a mistake to believe that activity generates great returns.
What about you in terms of...
I could just stop, rewind and play exactly what Chris said for the way we're approaching the equity market. So we're one of those fund managers that Chris spoke about that's able to hold very flexible amounts of cash, so a lot of variability. And right now in our private fund, we're 40% cash.
So my question that I was going to ask you was this. What happens with the Trump sort of losing steam? So in other words, both of you sound like you're waiting for a shock in the system to be able to...
No, well, I don't know, but I can't speak for Chris, but I suspect from the way Chris was speaking just then, it's exactly the same as ours. The cash becomes a remainder in your formula for your portfolio management. So once you've exercised, once you've implemented that formula, what flows out of the bottom is what's left over, and that's the cash. So when you can't implement your formula and find things that meet the criteria, cash is the remainder. And so we're holding a fair bit of cash because it is challenging to find good value.
I've seen a lot of fund managers have gone to cash of late. I mean, that's because I think they're sort of unsure of how the Trump story plays out.
Feel free to chime in any time, Chris, by the way.
If you were to think of something around the people that are viewing this, what would you ask them to look at today? What is the thing that you say, the storm cloud might be this? What's the thing...
OK, so I mean, you can shoot me down in flames for saying this, but I actually think it's credit related. There's a record in the United States, there's a record amount of junk bond credit that's due to be refinanced in 2019. It's over $400 billion. And I wonder whether or not the appetite will be there to actually refinance all of that junk bond credit, particularly given the spreads have narrowed so much already. It's almost as though they've peaked too early. And then what happens is if those companies can't refinance, and a lot of them admittedly are in the energy space, but if they can't refinance, then people lose their jobs. And then the perspective about growth and Trump and so on changes rather dramatically. I suspect it might even happen before that, but that's what I'm looking at the moment.
So, Chris, with that in mind, Roger, with Yellen moving on, and it's not, you know, not official that she's moving on, but the assumption is that she'll move on, and then Fisher, who's the vice chair, will lose the vice chair about 6 months later, I think it is. The thing about the Fed is there's 3 people to be appointed, and the risk is, the question is, who will President Trump appoint? So the Yellen behaviour, knowing that there's 3 coming, will be an interesting dynamic.
Yes, it will. I actually think I know that's, for us, it's a major point of interest. But for investors, it really doesn't matter, because ultimately what's going to happen is you're going to end up with a low return on long duration assets, either because there's no volatility but prices are so high that you've got, for example, on property, record yields now, record low yields on Australian residential property, so you're locking in a very low rate of return if you do have a tenant, by the way, because oversupply of apartments means vacancies are going to go up. And so you either have an environment with low returns and low volatility, or you have an environment with low returns ultimately with very high volatility, which means capital losses for a lot of people who are leveraged.
A lot of headaches. With that property market story, is the thing... So I want both of you to help me understand this.
Sure.
The property market, is it a Sydney-centric property market? So when I hear politicians talking about my daughter can't get a house and therefore we've got to make all these changes and that sort of stuff.
Yes.
You know, I don't know where I'm sitting on that fence.
Chris and I are both very passionate about property.
Sydney? Is it Sydney? Because if I'm in Darwin...
No, it's not.
I'm in Darwin, it's not. If in Adelaide, it's not. If I'm in Perth, it's not. So can that person go and get a job in Adelaide, Darwin or Perth?
See, people, it's amazing. The Perth market and the Darwin market and the Adelaide market...
Tasmania market.
Is a window into what the East Coast is looking towards. And, you know, the idea that you can have this major disparity...
They haven't had the rally. They haven't had the rally.
No, they had a...
No way
Perth had a massive rally.
Okay.
During the boom, right? They had an enormous rally. And the other side of it we're looking at now, it's a fantastic insight. You know, it's a fantastic insight into what can happen on the East Coast. And it will happen. I'll give you a quick number of little stats. In Brisbane, we'll just talk about Brisbane for the moment, in the last 12 months to September, 5,500 apartments were completed and released within 5 kilometres of the CBD. In that same period of time, vacancies went from 2.7% to 4.7%, 5 to 15 kilometres out from the CBD. So vacancies doubled with 5,500 apartments being released. Now, before September this year, there will be another 13,300 apartments completed and released to the market. What do you think are going to happen to vacancies? I hear property promoters...
People are complaining about the property prices.
Property promoters tell me that the only way there'll be financial stress... Property promoters tell me the only way there'll be financial stress is people lose their jobs. If you lose a tenant and you've leveraged to buy multiple apartments, you've got financial stress.
And we have an email from Jenny. And Jenny writes, with comparative advantage being eroded so quickly, are growth stocks a good place to be in today's rapidly disrupting world, or are we better to be higher up the capital structure?
Okay, very simply, businesses... There will be successful businesses and the owners of those businesses will still make very, very good returns. We will see, maybe in my lifetime, maybe in your lifetime, Mark, you're only a couple of years older than me, we will see the Dow Jones at 100,000. You know, it will happen. It won't happen anytime soon, but we'll see it. And it will be corporates that actually achieve that for their shareholders. Now, the fact does remain that it is a rapidly evolving world. Technology, we're going to see technology advance, not 100. We're going to see not 100 years of advancement in technology in the next 100 years. We'll see 10,000 or 20,000 years of advancement in the next 100 years. And so that means companies will be disrupted, but there are things that are known. We know, for example, that the baby boomers are ageing. We know that as the biggest contributors to hospital procedures...
We're keeping you awake?
You just yawned, Chris. We
just yawned on national TV. Okay, just want to make sure you're okay there, Chris. So he's been working very hard. He's got lots of meetings.
Yes, this is his 7th meeting tonight.
Yep.
So what we know is that companies, for example, companies that supply healthcare or conduct medical procedures for people, they're going to see increased demand. There's no doubt about that. We know a business like Challenger, it's going to see the amount of money switch from accumulation phase in super to pension phase go from about $58 billion out of the $2 or $3 trillion that's in super this year. In 13 years' time, that'll be $250 billion switching from accumulation phase to pension phase. So businesses that supply products that service that market will continue to do very well.
One of the things, Roger, is that the political response to economic rationalism has been all the people who vote for...
Well, most politicians are economic rationalists.
Yeah, I know, but
that's why there's lots of people that are left behind.
The Trump experience has been that I don't see the benefit. I'm not getting the benefit from your economic rationalism. So I want you to be irrational. I want you to put tariffs on things so I save my jobs. How do you think
that's how fascists and dictators are elected?
How do politicians respond to the artificial intelligence story that Chris is saying you have to make that fusion? Doesn't that need the leadership? How does that work?
Well, on the one hand, I agree with Chris. I think that opportunity is there. I guess I'm cautiously optimistic, and the reason for my cautious optimism is that I know that technology that was invented for a good is then often corrupted and used to kill other people. Oh. And I worry about that. But more importantly, I think, and more immediately, my concern surrounds the idea that capitalism ultimately results in an increased concentration of wealth. And it's that concentration of wealth, that's what's given rise to populist politicians.
Yeah,
you know, Pauline Hanson in Australia, Trump, and so on. And so that needs to change. And if AI accelerates that, then it becomes another problem.
Great. Look, that's all we have time for tonight. I want to thank our guests. They've been great. Roger Montgomery from the Montgomery Investments and Chris Joy from Smarter Money Investments. Have a great weekend. We'll talk to you soon.
The information featured in this program